global economy is doing fine. That was the message that we got from the monthly round of economic data distilled by JP Morgan and S&P Global, published today, summarizing what the world has done in November and how we're setting up for the month forward. But the U.S. throws up a bit of a red flag. We're going to pick it all apart here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. We're going to take a big view here, the 3,000-foot bird's eye view of the global economy, and see where we might have a bit of a concern emerging, even as everything else would seemingly say that we are in a relatively benign set of affairs. So let's first take a look here at the numbers that came out. This is from JP Morgan and S&P Global. It comes after a multiple week cycle where numbers for purchasing managers indexes from the world over come out. And then today we got to the distillation, the global numbers. And with those numbers, a sense of how things are developing. Now, of course, we can see here the composite index in the middle remains well above the 50% level. That 50 is the boom bust threshold for PMIs. Above them, there is growth. Below them, there is contraction. Below 50. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And the story here is not an unfamiliar one. We can see here that for much of the year, we have had services, that's in the red here, powering the move higher. The composite index, as we can see, tracks very closely to that. Manufacturing has been the weak part of the equation, ostensibly following in the wake of a kind of hangover for goods rather than services consumption when during the COVID period the tables were turned somewhat. We now have manufacturing in a little bit more of an anemic state, barely growing here, although coming out of contraction in November. But the overall index here ticking up for a second consecutive month after setting a low in September. That was the lowest, in fact, in 8 months or so. And we find here nothing really particularly screaming at investors to sort of signal novelty. It does, of course, look like we're still well off the highs from earlier in the year, but things don't appear to be careening this way or that. And the general internals of the report are broadly well supported, even though the pickup in activity is very modest. So with that, we get an interesting set of circumstances. Just as a reminder, what global growth is made of, how it gets there, fundamentally relies on three economies. This is from the World Bank, and it's been updated. It's updated annually, so the latest numbers here are as of 2023. The U.S. is the largest component of global growth, 26% of global GDP. And China and the Eurozone have just under a fifth apiece. Altogether, we have 58% of global GDP between just three economies. In the rest of the world, the remaining 42% are largely vendors to the former three and need those to have demand of their own. So think Canada or Mexico for the U.S., or Australia, or Southeast Asia, or significant parts of South America and Africa, and especially the commodity exporting ones for China, or Central Europe, Nordic Europe for the Eurozone. needless to say, these three are incredibly influential, and the US is the most influential among them. What makes today's global data, which again, by all measures, seems relatively benign, what makes that interesting in this context is in parallel, we also got a set of numbers on US service sector activity from the Institute of Supply Management. This is the US's internal PMI alternative, not the S&P Global version, which is relatively more optimistic and also an earlier conducted survey. This is a later conducted survey and from a competing source. And here we get a very troubling disappointment on service sector activity growth. From this lens, the U.S. service sector slowed to the most sluggish growth in 3 months. Moreover, it slowed unexpectedly. The expectation here was that we'd tick down from 56 in October to 55.5 in November. In other words, that we'd cool a little bit from the more than 2-year high that we hit right here, but it wouldn't be anything dramatic. It would be a kind of small back step. Needless to say, that is not what we saw here. We, as a matter of fact, saw a dramatic disappointment and a sharp pullback into this range that's persisted since about the middle of last year. So with that in mind, we have to ask ourselves a very important question. If this is the overall pie, and the U.S. might be misstepping here, certainly the numbers are not catastrophic, but that they missed expectations by this wide a margin suggests either it's a one-off or those expectations are tuned much rosier than makes sense. The U.S. then is looking a little bit soggier than the markets thought, and maybe not a little bit. Then do we still have as benign of a story here if 26% of the total is lining up a disappointment? And as we consider the internals of this report are not especially encouraging and really give additional pause to what's happening at the headline. Notice here, employment slowing, new orders slowing for a second month, but prices holding relatively steady. This represents probably the biggest issue in this situation. When we compare that global breakdown, look at those top 3 economies, what strikes immediately is the dramatic divergence that has occurred between the US and the other 2 since about the middle of this year, perhaps a little bit earlier, around April, May or so. And that's, of course, this right here. Europe was in what looked like a recession toward the end of last year. It marked a bit of a rebound from that in the first half of the year. It has now slumped all the way back into contraction territory. And recession-like conditions are back. China had this pop when it jettisoned zero COVID restrictions, which seemed to last all of 3 months. It has then slumped toward neutral and continues to basically limp along. There is virtually no activity in China. It is struggling to get off the ground. We just spoke last week on this very show about how for 6 consecutive quarters now, China has been in de facto deflation because real GDP growth is running hotter than nominal, which means that the price component economy-wide has a negative sign in front of it, which of course suggests the economy is essentially without demand. The whole thing is on discount. That, of course, stands in stark contrast to what's going on in the U.S., where, according to the S&P Global's version of the PMIs, and of course, given the drop we saw today in ISM, that version of a composite, even a weighted composite, wouldn't be quite as robust, but we do have to compare apples to apples here. If you looked at then the comparison, you can very clearly see the divergence, and you can see the U.S. growing briskly here. And of course, the markets have responded accordingly. And this is where the disconnect becomes an issue. If this is what makes for global growth, then this is where that global growth has been coming from for over 6 months. Because these parts of the story are anemic, and the gap with them and the robust US is only expanding. We can see right here. So if this is where that big part of the pie seems to be going, if we are suddenly witnessing the first missteps and the first bits of a slowdown for the US, well, then this total whole is operating without a safety net, which is to say, if the U.S. missteps, we are almost certainly on our way to some kind of a global recession. But of course, we have to stress the if, because there's no indication at this point that the U.S. is going to misstep. Certainly, at this stage, things are going as you might expect. Relatively rosy. As a matter of fact, we heard as much from Fed Chair Jerome Powell earlier today. He was speaking at the New York Times Deal Book Summit, and the comments he offered were generally very positive, saying, we can take our time, we don't need to rush, we do need to fine-tune interest rates and bring them down as inflation expectations generally come down, but we can proceed carefully and just make sure that the U.S. economy remains the envy of the world that it is. That all sounds very good. And of course, the markets have been on this kind of time for quite a while. When the Fed began to really signal overtly that rates were going to be cut starting in September, the markets very plainly looked at the pace of U.S. economic data the way it's been performing relative to expectations. Of course, by then, it had already spent some time starting to significantly improve relative to forecasts, and said, well, you're going to be cutting into an economy that's not cool. And you're going to be cutting into an economy that's warm. And then what that's going to do is lift inflation expectations and limit your scope to cut rates down the road. And indeed, we can see exactly that in the way that policy expectations have evolved. In the gray here is the outlook for U.S. rates for this year. As you can see, there's a sliver left, and in fact, this underestimates a little bit the probability of another cut in December. This would imply at 12 basis points that essentially we're looking at about a 50-50 shot of a rate cut in the final meeting of the year. But if we look at these indications actually adjusted to the date of the meeting, which happens in the second half of the month, how likely is it that essentially you get a cut in that particular week, in that particular day? You come in at a much higher setting at about 77-78%. So we're looking at one more cut here. If you take what the outlook was back at the start of the easing cycle before the first cut here actually occurred, you had 233 basis points in the forecast. 50 of them got delivered up front in September. Another 25 got delivered in November. Another 25 looks overwhelmingly likely for this month. So take 100 basis points out of that 233, and you're left with 133 basis points for 2025. Consider now the market is looking for 67. So over the past 2-3 months or so, what you've seen is a dramatic cutting back of Federal Reserve rate cut expectations around the idea that the economy is doing fine. It's doing this. And it looks like this relative to the rest of the world. It doesn't need aggressive rate cuts. And indeed, the prospect of aggressive rate cuts has shifted up inflation expectations. And so, needless to say, the market signal is quite clear. The issue here and the fundamental risk in the disbalance between the US and the rest of the world is that monetary policy as set in the US extends to the rest of the world. We can see that in the relationship between US yields and those of other major economies and sort of the general cost of capital the world over. Notice, here's the US 10-year yield. Here's an average of rates at the same 10-year tenure in Germany, the UK, Australia, and Japan, just to use 4 big economies with large debt markets. And what you find is that they follow in tandem. They move in parallel. And this is, of course, because the US dollar is the quintessential unit of global exchange. So when the Fed alters the cost of borrowing dollars, since almost all global monetary transactions are ultimately settled in dollars, close to 88%, according to the latest data from the Bank of International Settlements, BRICS pretensions notwithstanding, the adjustment in the cost of borrowing dollars basically means an adjustment in the cost of borrowing for any economic activity the world over, and so global yields move with the Fed. So therein is the issue. In the US, you have a robust economy and every reason, seemingly, for the Fed to move at best slowly on cutting interest rates, and we've just seen the market's baseline outlook cut in half over a short span of time. You've seen the Fed, including the speech from Fed Chair Powell today, endorsing that readjustment, basically saying there is no emergency, we don't need to cut a lot. The markets are right to think that we're going to proceed slowly and modestly. Meanwhile, the rest of the world is in a troubling state. So, on one hand, one might look at this and say, well, if the US is in fact slipping, as this would suggest, well, then the Fed will just cut rates more, and then global rates will fall faster. Maybe so. And that is a forward-looking way to consider it. And of course, the other side of it is that if the US economy isn't faltering, or if the Fed is not reactive enough, if it's not moving quickly enough, then the window might get missed, and the one leg of the stool here that can't afford to get kicked out does. And this is where things start to get troubling, because there could be a catalyst here that makes the process move faster than would just a regular economic downturn. Economies are slow. They are not speedboats, they're barges when they turn. So these signs of weakness that we just saw out of the US, they're troubling, and they do put a threat on the one indispensable piece of the pie here, given the imbalance. But it would take some time for the US economy to really and truly wreak havoc as it turns, unless something were to drop a big bucket of fuel on the fire. And as ever, that's debt. What we find here is from the IIF. This is their latest, or at least the latest I found, index and report on total global debt, which we can see is seen hitting a record $315 trillion in 2024. We also see that the debt to GDP ratio globally has been falling, largely because in the years of 2021, 22, 23, less so then, inflation was inflating the debt away. In other words, people were paying down debt with inflated money, and so the sting was falling back. But of course, with aggressive rate hikes and with inflation coming down, this has stalled. And the problem would then become if global growth were to start to slow because the US were in fact hitting some kind of a roadblock, as the ISM data would suggest, this would go up because debt as a percentage of backpedaling GDP would of course rise and increase the service cost and the servicing pain from that debt. Worryingly, that would happen at the same time that US corporates face a refinancing cliff. Now, we can see here, this is a chart from The Economist, that every major tightening cycle, going back to the mid-70s, early 80s, saw non-financial corporates, just regular corporate America, start to pay more in interest when rates go up. This should not be controversial, of course. This is exactly what's supposed to happen. Central bank wants to slow activity, wants to control inflation. It raises rates. Companies then have to finance debt at more expensive levels, so they have to pay more because rates to borrow are higher. That cools the economy. No shock there. That's exactly what's meant to be occurring when the Fed raises rates, or any central bank for that matter. Notice this most recent tightening cycle is pointedly not that. Non-financial firms' expenses on servicing credit, their net interest payments, have actually fallen into the tightening cycle. And that's because during COVID, these companies seemingly gorged on credit that cost nothing. And so they were cash rich going into the tightening cycle, and at this stage have actually not really borne the brunt of the higher rates. Now, generally, this kind of borrowing has a 3 to 5 year rollover window, and of course, going into 2025 would put us squarely toward where a lot of these redemptions and rollovers are concentrated, both next year and the year after. If this is an environment in which lots of debt has to roll over, it's growth that would need to paper over the higher borrowing costs, because essentially there is almost no way that a lot of this debt isn't refinanced at 200, 300, 400, 500 times the interest rates that were incurred initially, just because of the tightening cycle that's occurred. If there is rapid economic growth, then those expenses can be paid for essentially out of future earnings. Companies that see those kinds of expenses can refinance them, hopefully at improved terms, by saying, look, everything is growing, we're making a bunch of money, this is not an issue. But if the U.S. were to misstep, and indeed if the debt to GDP ratio were to start rising at the same time that this is occurring, then any sort of imbalance in the global economy would get put on steroids. Because to the extent that there would be suddenly a choking off of credit and a rapid deterioration in the economy, well, the Fed may not catch up fast enough with rate cuts, which can take between 12 to 18 months to actually filter into the broader economy. And so the vulnerability then is there is some sort of refinancing squeeze just at a time when, if this part of the puzzle falls away, everything else starts looking dismal indeed. Now, we don't have any evidence at the moment that this is occurring, or that this has come to a head. But the stage has been set in a way that bears very close monitoring. Of course, the first step in that will be the U.S. jobs report that's coming at the end of this week. We'll talk about that in granular detail on the show tomorrow. As ever, Macro Money is here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. In just 30 minutes time from now, as I am every Wednesday, I'll be on with Victor Jones for The Price of Truth. I'm on with Chris for Futures Power Hour Mondays and Fridays. I'll be there this Friday. On with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting on the platform formerly known as Twitter, as well as on Blue Sky at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.